Sure. Well, my apologies for the situation that we hit at the moment. I did an update last night on my computer, and it was one of those Microsoft updates, and it seemed to find a little trouble with me. But anyway, hopefully we're now there. Hopefully we're ready to get into our presentation for today. My name is Alec Hogg. Let's see if this is going to work. If we, I see. Isn't this interesting? Anyway, as long as you can see the screen, let's just make sure that everybody can. Would you raise your hand? There's a little hand button there. If you can see the screen, please. Fabulous. Thank you very much. Thank you very much for doing that. And as always, I'm in London, and my colleague Stuart Lowman is in Johannesburg. Stuart?
Yes, thanks, Alec. Always good to be here. Apologies for the little delay. Somewhat chilly Joburg today with a bit of rain, but otherwise lovely to be here, as always.
Don't talk chilly. You're talking to someone more than him here at the moment. I can tell you what, we're at 2 degrees. Sorry, I apologize. 6 degrees at the moment. So it's a little better, but we're getting. I'm in training for Davos, Stuart. So when I go there in January and it's -6 or -10, hopefully I'll be suitably attired. As remember the wonderful saying of Benjamin Zander, who said that his father explained, "There's no such thing as bad weather, just inappropriate clothing." Well, I'll be sure that that I have appropriate clothing when that happens. Let's get into the presentation now. Just to remind you that the SA Champions portfolio is all about hedging against the rand by investing in South African global champion companies, and we do try to find those that are driven by its best entrepreneurs. That's really the essence of what we're doing here. Find a super rand hedge, if you like, and if the rand performs well, then clearly you would be under a little bit of pressure. On the other hand, it's a lot of stock selections, and stock picking is a important part of this portfolio. As relevant is the rand dollar, and as you can see in the past year, the rand has been a little weaker. Well, we started the portfolio on the 23rd of January, and as of yesterday, when I closed things off, I did all of this last night because you can imagine it's 8:45 in South Africa, in the UK at the moment. As from the 23rd of January to the 14th of November, the rand went from 13.50 to its current level of 14.40. So the rand has depreciated, and we have seen the impact of that on our portfolio in some positive sense. However, it's been very turbulent, and as you can see, during much of this time, the rand also was a lot stronger than it was trading at when we started. So this is a little bit of a balancing act. And that's why my suggestion is usually that if you're going to buy stocks offshore, what you should be doing is staggering your purchases over 3 months. Because as you can see from this table in front of you, the graph in front of you, that the volatility of the rand means if you buy it at the wrong time, you can look very silly. Look at that in mid-April if you happen to have taken money offshore. And then by the same token, had you decided to make your investment offshore in mid-June, you'd look pretty good. But if you'd gone mid-April, mid-May, mid-June, you'd have averaged out quite well. So that's the story. Try and average out when you're investing offshore. This, of course, is a bundle that we have with Easy Equities. And as a consequence of that, we change the bundle when we change our portfolio. And there's some big portfolio changes in this period. Just one other graph that I wanted to point out as we start. The all-share index on the JSE has done very well in the last year. It's up 20%. In the period that we talk about, from the 23rd of January until today, it is up about 12%. So if you go year on year, that's what this graph is showing you. 20% gain since November last year. We, of course, only started the portfolio on the 23rd of January. So there's a 12% gain, which we are underperforming, and there's some very interesting reasons for that. The rand hasn't really fallen out of bed, and the other reason for that is that we had one disastrous investment, which I'll tell you about in a moment. Just to start off with, on the 23rd of January, the portfolio changed going into today. we sold those blue labels and switched that into Naspers at 25.60, with Naspers sitting at well over 33,000 Rand a share. That's clearly hasn't been a bad investment. It's been a good switch. And similarly, we sold Wilson Bailey and bought into Glencore at 47.50, and with that share price just under 70 Rand, it was also a good switch. Let's hope today's ones have the same consequences. Here's what we're doing today. Well, I've lost patience with Brait, and there's very good reason for it. We sold out of Brait. In fact, in the last few days, it's been done already in the portfolio. If you're on the Easy Equities portfolio, you don't own any Brait shares anymore. 190 of them were sold. That's what we had in the portfolio at 48.60 Rand. And that, unfortunately, has been an awful investment for us. I'll go into some reasons for it in a moment, but essentially we've taken a 39% knock on the Brait investment. On the other hand, we were pretty fortunate with Glencore. We bought those in, as you saw on the previous slide, at 47.50, and we sold them out at 69.28. Now, I'm not a trader, so it wasn't an intention to buy in and trade in either of these stocks. Both of them, the intention was to hold them forever, but circumstances have changed rather dramatically in both instances, and that is the reason why both have been sold out. We have bought into the portfolio 178 FirstRand shares. What it means essentially is we put 8% of the portfolio into FirstRand. Why FirstRand? Well, FirstRand is in the process of becoming a global champion. It's made an acquisition, or in the processes of making an acquisition of a company called Aldermore, and I'll give you more insights into why I believe that this is a fantastic deal for FirstRand, and into the future it's going to reward shareholders significantly. And then we bought more Naspers. 3 more Nasperses, which cost us 10,775 Rand. Which has taken the portfolio now into an overweight position on Naspers. And it's a very important situation to be in, because the South African dominance of Naspers on the South African market means that you either go underweight if you go on less than 25% of your portfolio in Naspers, you are underweight the SWIX, which is the South African owned shares in the JSE. 25%. That's how big Naspers is. In fact, Naspers's market capitalization is worth 1/3 of the South African economy. And the reason why Naspers has been such a screaming success story is because of its investment in Tencent. And Tencent we have as a separate holding in our global portfolio, and that's been one of the star performers there. In fact, in the last month, it's gone from 350 to 390 Hong Kong dollars. Just keeps soaring. Anyway, we've decided to go overweight Naspers. After starting with a small position of only 8% in Naspers, we then bumped that up. As you can see, we bought 3 Nasperses in May, and now we're buying another 3 of them in November. What that has done is change the portfolio structure quite significantly. Our portfolio now will have 31% of its investment in Naspers. In other words, we have gone overweight the Naspers shareholding, and it would have been a good idea to have started off like this, because at the beginning of the year, Naspers' share price was considerably lower. In fact, it's gone up more than 70%. I have no reason to doubt that it's going to go higher still, particularly because of a view that the Rand at this point in time is extremely vulnerable. You can see there that the 15% investments that we started off with in Discovery, Investec, and Mediclinic are still there. Out is Brait, which was a 15% as well. Out is the 8% that we had initially in Glencore, or that we invested into Glencore. The one made a good profit. Glencore, on each 100,000 Rand that you have in the portfolio, Glencore generated about 4,000 Rand, well, call it 4 Rand profit for every 100 Rand invested, where on the other hand, Brait lost 6 Rand for every 100 Rand invested. So thank goodness the one offsets the disastrous investment. And as Warren Buffett says, you should be talking most about your losses and the things that you got wrong. And boy, did we get Brait wrong, but not as wrong as the people who run the company got, and certainly not as wrong as many other investors have done. We were inspired by Brait by the investments that were being made by the insiders, but they got it wrong really badly. Anyway, We'll get onto all of this in just a moment, but let's start off with Brait. One of the reasons we went in there is because of Christo Wiese, the great entrepreneur who's done amazing things in South Africa. He's also been pretty fluid in his investments into the UK, but on one investment he made an absolute disaster. It's got to be the worst investment made by any South African company in the world ever, and that's a strong statement. He bought a company called New Look, which is a retail chain in the UK, and the investment that Brait made was £780 million. Brait has written that down to zero, and the investment was only made 2 years ago. Okay, if you've got, and I'd like to hear if somebody's got some other ideas in the webinar later on of an investment that even rates as bad as this one. Throughout, we've held it. The share price of Brait has gone down. I've got more and more bullish because my intention, or I listened to what the managers of Brait believed. Incidentally, they only did the deal in June 2015. So it's just over 2 years, and they've lost £780 million. You work that out in rands, and you're coming up to, well, 35 billion rand. Extraordinary that they've written off on this company. The rest of Brait is looking pretty solid. The investments they've made in Virgin Active and Iceland Foods and Premier is all very good, but at the time they made the investment, New Look was about half of the portfolio, and the time we bought in, it had dropped to as little as 15% of the portfolio. Now it's dropped to zero, absolute zero. Why are we selling when they've already written off the whole investment and the share price has fallen in the way that it has? 48.69 was the price that we got out at yesterday. Well, have a look at that. You can see that the decline in the shares, this is over the past, since we started the past year, has been relentless. Is it going to go further? It could. But in a case like this, you have to consider whether it's going to be able to rebound, and that I don't see happening. The investments that Brait have outside of New Look are solid and are likely to continue doing reasonably well into the future. The New Look investment, unfortunately, comes along with £2 billion of debt. Now that's, although they've written down their investment, their £780 million investment, to nil, the problem is this company is still deeply indebted. And as a consequence of that, Brait is almost caught between a rock and a hard place. It could walk away from the deal now, and probably the bankers will come after it for the debt that's sitting within New Look. It could also sell New Look to somebody else, maybe even have to pay somebody when you take on so much debt. The problem with New Look is that it does appear to have been completely, we've all been completely misguided in the information that's been coming out of Brait on this one. To me, I was of the opinion that with Brait itself buying back its shares so aggressively, and with even the management of Brait buying back or increasing their stake in the company, that they must have seen something in New Look that the market wasn't seeing. As it now happens, the managers of Brait and the executives of Brait appear to themselves have been misled. The chief executive of the company did leave. The man who'd been there for 5 years did leave recently. They've now brought back the guy who was there before, the Scandinavian who was running the company. And the hope for Brait shareholders is that he will be able to turn it around. But in the media here in the UK, the stories that we get is that he's not terribly impressed with what he has discovered. New Look was moved from being a bit of a discount play, which is where Christo Wiese's strength is, into a focus in fashion, in women's fashion. What I also liked about it was the investment into China of more than 100 stores. But if you get China wrong, you lose a lot of money. So that's where we are. We've looked at Brait carefully. To me, the upside potential is now going to take a long time to come through. It's not the kind of stock I want to be invested in with the high risk that's there, and I'm sure that you will agree that the portfolio is going to be a lot better off not having this one in it. A 39% decline that from 15% of the portfolio has been quite a hit that we've taken. So there's the Brait story. Best to, when you appreciate that you've made a mistake, best to get out. How much further can it fall? I don't know. There is still a lot of downside risk here, given the debt that sits in New Look. How quickly can it recover? It's going to take time. And if you put that into the rational brain, you can see what the consequence is. Glencore, on the other hand, was a stock that we bought for its electric car option. That's a picture of Ivan Glassenberg, the chief executive, and it was taken from a webcast that the company did for their annual general meeting, at which Glassenberg explained to us why Glencore was so well positioned for electric cars. And he certainly is, and there's nothing to change your mind on that. What bothers me about Glencore, though, is on the one hand, the electric car premium, if you like, has been certainly built into the shares. It's surged by almost 50% since we bought in, and by considerably more from its bottoming last year. But the other thing is that they did appear in the latest scandal, the Paradise Papers scandal, where Glencore was operating, or a big part of the legal firm who have been investigated by journalists from all over the world for a period of time, a bit like Mossack Fonseca in the original Panama Papers. They had a whole war room for Glencore, and a lot of the work that Glencore did was in the DRC, and some of that work was with a chap called Dan Gertner, who is not the kind of person I would like to be in business with. As a consequence, we've had a good run with Glencore. The price of these shares is now fully discounting, certainly in the medium term, the benefits it'll get out of electric cars down the line. But the risk here has grown, given the what has been going on behind the scenes, stuff that we didn't know. You might remember that we sold out of Barclays after that was in the global portfolio, after it became apparent that the chief executive of Barclays was gunning for a whistleblower. So instead of supporting a whistleblower, they were gunning for it. That worries me. I would rather do business with people that I can fully trust. It worries me that Glencore is doing business. It is doing business with people that certainly I'm not very comfortable being in. So off we go. Goodbye Glencore. Goodbye Brait. And the portfolio, there we go. The Glencore investment, which has treated us very well. Thank you, Glencore, for performing as well as you have. But we would rather let somebody else take the risk from here. And here it is. The one that I'm very, very happy to be invested in is Naspers and Bob van Dijk. We are now, as I said earlier, overweight Naspers relative to the JSE. That is our index that we will be looking at as a comparison. We've underperformed the JSE All Share Index, as you saw earlier. Let's just go back to that quickly. There we go. You can see on that, on the Champions portfolio graph, we have achieved a 7% profit on the portfolio overall, pulled there by Naspers. Our benefit on Naspers, of course, has been much higher than the 35% that you see there. That's the average profit on the average price, and we've averaged in our price at 26.59. Our initial purchases were much cheaper, or much lower than that. Discovery has done well as well, and Investec has, together with MTN, pretty much level pegged. Mediclinic, we'll talk about them in a moment, are under a little bit of stress, and then Steinhoff too have been the poor performers. But again, on both of those, I can live with them, and I'll tell you exactly why. Whereas on Brait, not so happy. Naspers, just a phenomenal company. The past year's share price performance tells it all. But the real reason here is the investment that Naspers has in Tencent, and more than that, the brilliance of the Naspers management in deflecting those who have wanted at any time in the last 20 years Naspers to take profits. You ride your winners. You ride your winners and you stay with them. If that is one thing that we've learned from the Naspers story, it is something that we should be bearing in mind here. Tencent is a company that has come from nowhere to be the major player in the Chinese internet market, and it is a company that is continuing to expand. Just to put it in perspective, it is unlikely to be threatened by the big internet companies from the United States, because they can't get into the Chinese market, for starters, or if they do, they come in under very strict rules. The Chinese government is promoting Chinese champions rather than allowing free competition. You might have moral objections to that, but the reality is that's the way the economy works in China at the moment anyway. And Naspers owns 34% of the company that dominates the internet space. But B, the reason why it is impregnable to attacks from the likes of Facebook, Apple in particular, even Samsung, is that in the way it works in Tencent is that the operating system is irrelevant. The app, the WeChat app, is the dominant operating system, if you like, in China. So Tencent has got 900 million people who use the app on their phones and their computers every day. That's the reality of where they are. So whereas if you were in the United States, you would use the Apple operating system, in China, Apple will have its own operating system, but the user will actually apply the WeChat or the Tencent-owned app. And that gives it a unique position in its own market and one from which to actually expand elsewhere. You might have seen in the past week, Tencent bought a 10% stake in Snap. So it's looking to go head-to-head with some of the big technology giants in the US through the owner of Snapchat, recently listed. And it's also bought into Tesla, so it'll be partnering there as well. There are some very interesting plays that one will be seeing from Tencent in future. And whatever else you want to think about Naspers, it's a cheap way into Tencent. It trades, the value of Naspers trades at a discount to what it owns in Tencent. Everything else that comes with Naspers is a bonus. So the wonderful deal and the wonderful work that's been done by Bob van Dijk, the chief executive, who's been there 5 years now, on things like the Delivery Hero in Germany, Flipkart in India, and other investments, PayU, the big emerging market payment system that Naspers owns, and it's making more and more of its own progress. It recently acquired a chunk of Remitly, one of the big payments operators in Silicon Valley. So all of these things are now working in our advantage or in our favor just by owning the Naspers shares. It has the other advantage that if you don't have a lot of them, then you're going to be underweight against the JSE All Share Index. And of course, the big advantage here is that the Tencent share price is traded in Hong Kong dollars, and the Hong Kong dollar is closely related to the US dollar. And as a consequence of that, if the Rand falls, Naspers automatically, the value of its investment in Tencent rises. So it's the perfect Rand hedge. Imagine this, you're actually buying Hong Kong dollars, or call it US dollars, at a discount. That's what you're doing with Tencent, with Naspers shares at the moment. So it is almost the perfect hedge for somebody who's nervous about the Rand and what's happening in Zimbabwe today. Has to make you even a little more nervous than you were perhaps when you went to bed last night. Our second...
Just a question on Naspers, so before we get into FirstRand. I think it comes up quite often. Bio wants to know, he says, recent articles note that the other assets within Naspers, excluding Tencent, are loss-making and have low to zero value. Just your thoughts on that.
No, well, you're half right and half very, very wrong. Where you're right is that they're loss-making because they're investing. It's what happened with Google. It's what happened with Facebook. It's what happened with Amazon. I mean, Amazon is loss-making, if you want to put it that way. They've recently, only after 30 years of business, excuse me, not 30 years, 25 years of business, they've recently only broken into profit. So what investors, what we need to understand in an exponential portfolio, and in the way that the world is moving in the fourth industrial revolution, is that the old system of buying blocks that are going to give you profits year after year, excuse me, and then it's going to give you a PE ratio that you can work things on. In other words, a very simplistic approach, a rational approach, but rather simplistic, where you can look into the future and be quite comfortable with what that company is going to be generating. Those companies are few and far between. In the fourth industrial age, what you're having is technology companies who are wiping out the old business models. Just look at Amazon against Walmart. In fact, look at I'll have to have a sip of tea quickly. Excuse me a minute. There we go. That's better. If you have a look at any of the exponential companies and what they're doing, these technology-driven companies, they're doing to entire sectors, you will see that the rules have changed. The rules of the game have changed. Now, one of the worst things in investment is when you are told things are different. This is a new era. But wherever one looks, in the fourth industrial age, the fourth industrial revolution, things are turning topsy-turvy. So don't worry about the bets that Naspers are making, or is making rather, that are not yet generating profits, because it is doing a Google, it is doing an Amazon, and it is doing the right thing for this kind of market where you are investing to acquire market share. At some point in time, you can switch that on, as Facebook, Google, Amazon have done, and the profits will be exponential. That is what the rump of Naspers is doing. So they've got the best of all worlds, if you like. They have this huge investment in a massively profitable business in Tencent in China, which dominates that market and is going into new areas all the time to generate more dominance in new fields. And on the other hand, they've got their own pot of gold, which they're allocating to different investment opportunities, like PayU, like Flipkart, like Delivery Hero that I mentioned, and there are numerous others. And they've also been smart enough to get out of some companies. Allegro was one that they recently got out of in Poland for 2.5 billion euros, which, again, they could deploy that cash better. This is a fine company. It is a global company. It's a world-class company run by world-class executives who have been educated in humility. And humility is the one thing that I often find lacking in companies of the old industrial, of the old era. They think that things are going to be the same into the future. They just aren't. And if you have a look at share market performances over the past couple of years, that is something that should be coming out and emphasizing.
Thanks, Alec. So it seems Naspers has generated a bit of interest here. Moore wants to know, he says, in terms of investment strategy, as a young guy with a young family, not a huge amount of cash to invest, how risky is really overweighting Naspers within a personal portfolio, 50% plus? 50%
plus? Wow. You know, there was a time, I remember I had an email from someone not long ago when I was really hot on Brait, given that Brait had spent so much money. It's taken and bought back something like 10% of its equity. And I thought, well, a smart guy like Christopher Wiese, who's been around the block, he's in his 70s, he's seen it before, he wouldn't be throwing good money after bad. And this person, and so that I wrote that as an opinion. And I had no intention then of selling Brait out of the portfolio. A consequence of that, somebody actually, it might even be on the webinar today, emailed me and said, shall I put everything into Brait? It looks like such a good thing. And thank goodness I wrote back and said, no, that's a dumb thing to do. You don't overinvest, especially in risky situations. And as we saw from the Brait share price, we were trying to catch a falling, or anyone investing there now is trying to catch a falling knife. On the Naspers side, as much as I love the company, as much as I think I'm very happy to have 31. In fact, we've got 34% of the portfolio in there because of the appreciation in the share price. I'm very happy to have, say, 1/3 of the portfolio invested. I would be cautious to go any more than that, because the chances are something unexpected is going to happen at some point in time. And that is the reason why we diversify our portfolios. You're a young guy, you look at this, you say, well, in 20 years' time, Naspers will outperform everybody else. It probably will. But on the other hand, by putting all your eggs in one basket, you are looking for trouble. Buffett says, have a few eggs, put them in a basket, and watch them carefully. And what I'm hoping we have now with the structure of this portfolio, and you'll see as we go into it more, is we have those few eggs, the right eggs now, with the big one being Naspers and quite a few others that have great potential. And then we watch them. And when a Brait happens, we get out. Or a Glencore happens, we get out.
Thanks, Alec. Margaret says, thanks for addressing the issue on changing strategies with the change in stocks. She says, previously we were wedded to dividend-generating shares. Where do they feature in this new world?
Margaret, it's the same response as the one earlier to PE ratios and profitability. You only pay dividends if you're profitable. As a consequence, if you are investing in a new era or in a new environment for the world, you should be looking at those companies that are doing the investments rather than those companies who are throwing the cash back at shareholders. Sometimes you'll get a case like Apple, which can't find new investments. Literally, it can't. It's got such an amazing ecosystem. It's got $200 billion in cash, and it's sitting on the cash looking for something, but not sure what. Now, what do you do with $200 billion? It's not a lot of companies that would be outside of your radar if you wanted to acquire them. So I guess what's happening in the Apple mindset, but they don't, Apple also doesn't like making acquisitions. They like to develop organically. In their mindset, they're saying, okay, let's give shareholders some dividends as well. That's fine. Live with that. But in a case like Naspers, if they were to start giving huge dividends, they've got a fractional dividend yield. If they were to start paying out 5% of their profits in dividends, or 10% of their profits, you've got to start worrying, because it's telling you that they don't believe they can find better homes for that cash. In their management team can't find better homes than actually just giving the cash back to you. And that the obvious instance or example of all of this is Berkshire Hathaway, where Warren Buffett has never paid a dividend because he believes that he can find better opportunities. And remember, he deals in the old economy. Okay, he made a big investment in Apple, which is now his second biggest shareholding. But for the most part, Warren Buffett says, I can invest the cash better for you than you can for yourself, so I'm not going to pay you any dividends. So the whole dividend distribution fashion, it came into fashion at a time that companies were maybe wasting their dividends by buying back shares at inflated prices, but it isn't in essence the kind of policy that you want to be seeing, that you want to see from a company, because it sends other signals.
Excellent, thanks, Alec. I think we can move on.
Well, let's move on to this. Isn't that a beautiful photograph? That's Bank Station. I go there often. Bank of England behind it. That's why it's called Bank. It's in the centre of the city of London, and that's where the three guys on the left, the three entrepreneurs who started FirstRand, G.T. Ferreira, Paul Harris, and Larry Dippenaar, are going to be spending a bit more of their time in the next little while. They're making an investment of £1.1 billion in a company called Aldermore. Up to this point, only 4% of their income, of the group's income, is being generated in the UK. They're expecting that that's going to significantly increase after this acquisition. And I like the fact that they're making the deal at this point in time and the way that they're going on it. FirstRand, first of all, when you look at it as an investment case, although this is a SA Champions portfolio, you've got to see what the bulk of the assets are in. And the bulk of FirstRand's assets right now are invested in South Africa. They've got a holding in the rest of Africa, and they also have a business in India. But essentially, you're buying a South African banking business right now. The value of that business, in my opinion, is still pretty reasonable. This is a 5-year graph that you can see on your screen. You're buying into the company at the current price, or we bought into the company at the current price levels, at the same level that it was trading at in 2015. So you're getting a stock at a 2.5-year price level. What's it done since 2015? Well, I took a few numbers out. I pulled some figures out since then. Assets are up 15%, deposits up 15%, headline earnings up 12%, but more importantly, when it comes to banks, the net asset value, the tangible net asset value is up 20%. So you're getting a stock today at something that, well, a company today that is worth 20% more than it was worth 2.5 years ago. That can't ever be a bad thing, unless the company is about to hit a brick wall, and then it is a very bad thing. In FirstRand's case, is it about to hit a brick wall? Absolutely not. When you have a look at the South African banking market, it continues to dominate there. Its technology investments are paying off. Rand Merchant Bank, on the investment banking side, is the market leader. FNB is the market leader. Westbank's the market leader. So it's done incredible work within its home economy, and now it's getting ready to expand into the global market with a vengeance. The company it's bought, Aldermore, is a smallish bank. It's what they call a challenger bank here in the UK. It was listed, only started in 2009 to have a go to set out to disrupt the UK banking market, to disrupt the status quo. And I would urge you to go and read the transcript or listen to the interview with Metro Bank's chairman and founder, Vernon Hill. Metro Bank is about the same asset base as Aldermore has, so it's an interesting point, the scalability or the size that FirstRand are getting in. And Vernon Hill says he cannot believe how useless the big five British banks are. As somebody who lives in this country and has had the misfortune of dealing with them, I cannot believe it either. One of the reasons perhaps is because the banks were most of them had to be bailed out in 2008 and 2009. And when you're bailed out by the government is a hard taskmaster. It wants its money back, and it also wants to make sure that you aren't wasting any money. In many people's cases, a bureaucrat will see marketing, for instance, as wasting, or good service levels as wasting, when indeed they're really nothing more than investing in the future. As a consequence of this, the British banks, the big five banks, Vernon Hill of Metro calls them the big bank cartel. They have become fair game, fair meat. And for a very, very good operator like FirstRand is to come into the UK market, to attack those big five banks directly or head on, is just music to any ears of somebody who wants to get in at the ground level. The point is, they're not coming in here waving the flags and saying that's what we are out to do. It is likely to be a consequence of the investment that they've made. Aldermore has itself said that's what they want to do, and they started off with asset finance, invoice finance, mortgages, and certain deposit products. But it's very instructive if you read through all the information that FirstRand has put on its website about the rationale for doing the deal. It amongst the rationale from both sides, from both Aldermore's team. They've got about 1,000 staff at Aldermore, 230,000 customers. So it's a sizable bank. They've lent £8.5 billion already. In South African terms, you're talking about 160 billion rand. That's big in a South African context. But what both sides are saying is that they're looking to expand into this market, bring in new products, and look to bring in new competition to UK banking. Those top five banks, the cartel banks, as Vernon Hill calls them, are extremely vulnerable in the UK. It looks like FirstRand is making a serious challenge against them. Only recently, FirstRand, incidentally, opened a branch in Guernsey, a retail transaction branch. They've got about 3,500 clients there. Already they've got deposits there of £215 million. But its existing operation's been going for quite a while. It's called Motor Novo, a second-hand car finance company. It's got a book of over £3 billion and makes profit of £69. £69, £69 million profit. You work that out, you're talking, getting close to £1.5 billion or around £1.5 billion rand. That's not a small business. So they're going to be putting together MotoNova with Aldermore, and watch out UK banks. I'd like to be in on the ride here. Knowing FirstRand from the South African context, what an amazing performer it has been in the South African market, you have to believe that it's got a reasonably good chance of succeeding in the UK. Knowing the UK market, and again, just go and read that. I see Stuart's put it up on the chat channel there. Go and read that interview with Vernon Hill. It's extremely instructive. He's going for a different approach. He's going very much more on Metro Bank is on the retail market, whereas FirstRand will be going for a far more targeted approach, and you can be sure that they'll be very strongly technology driven. Having accounts in both countries, the South African banking technology is world-class, probably world-leading, and bringing that into the UK, into a market where people are a bit jittery about their banks anyway, is not a bad thing. Just a final point on FirstRand and the UK advance. What makes it easier to build up a base of clients in the UK, even though the surveys say only 1% of Brits like changing their banks, what makes it easier is they have an arrangement between the banks where you literally sign if you want to move your bank account from one bank to another. This was done as part of perhaps a preemptive strike against the politicians, forcing them to do this. If you want to move your bank account from one to the other, it's incumbent on all parties that happens smoothly. So it goes formally, it goes smoothly, and it makes it very easy for people to move their bank accounts. I'm very excited about this Aldermore deal. Did they buy it expensively? No. They're paying 1.8 times book. FirstRand trades at about 2.8 times book. So depending on where you want to put the share price at the time, it was a premium on the closing price, and the investors in Aldermore have made a good return since the company was listed on the stock market 2.5 years ago. They've made about 63% once this transaction goes through. What I also like about this is there's no new shares being issued by FirstRand. It's a cash-only deal, and it will reduce the exposure to South Africa and hence make the company a good participant in our portfolio. Interesting story, this one, and I'm looking forward to going along for the ride, as we all are in this portfolio. So there are two things that can lift FirstRand. First of all, if the right kind of decisions are made by the ANC in December, the moribund South African economy will definitely see an uptick. You can't buy a company on that basis, it's too high risk. But what you can say is that the downside from where we are in the South African economy right now has to be limited. The crooks just can't get away with more. They can't channel more money out of the country. Those routes have been blocked. HSBC have blocked all the Gupta bank accounts. So that's one good thing that's happened there. So you have only upside, if you like, from December as far as a banking institution is concerned, and share price not moving in 3 years gives you a reason or a rationale for that. But secondly, their investment into the UK could be very, very exciting indeed. It's a good long-term investment. It's a kind of stock that I'm going to be happy to put into the bottom drawer and then look at it in 5 years' time, as Buffett says. If the market were closed for 5 years, would you like to own it? Very much so.
Thanks, Alec. Just on FirstRand, obviously with the move into the UK, Ian Ross wants to know any thoughts on the Rand-Pound exchange trend?
Ian, yes, that is probably the best play if you're going to be if you're a betting man. You would be of the opinion that the Rand is likely to weaken against the pound over the long term. In the short term, there's lots of moving parts. There's December with the ANC, which, as far as the Rand is concerned, could go one way or the other. It's a watershed for the country. I believe it's going to go the right way, so I believe that the Rand will probably enjoy temporary strength as a consequence of what happens in December at the ANC. And again, a big signal's been sent by what's going on in Zimbabwe right now with Mugabe finally, it appears, coming to the end of his reign. the second thing, though, is in the UK, more and more you can see that Brexit is not going to be the dramatic shock that people in the markets in particular have been hedging against. We had yesterday the news that Theresa May has agreed to put the final Brexit deal before Parliament, and so Parliament will vote on the final Brexit deal before Brexit happens. Now, this is a big change. It was quite well covered yesterday, but it hasn't been fully appreciated yet, because if the final deal that the EU and the Brexit negotiators put on the table is unacceptable to the British people, and as Philip Hammond, the Chancellor of the Exchequer, has said numerous occasions, the Britons did not vote to leave Europe to become poor. So if Brexit is a bad deal, then the parliamentarians will vote against it or lose their seats, essentially. So that's the one thing. And the second thing that's coming through is yesterday, even the biggest pro-Brexiteer, the Brexit Minister, Davis, got together with the financial services community at the Landmark Hotel in London. And at that meeting, he gave them everything they wanted plus. So it appears as though rationality is coming back into the whole Brexit debate. What that will do, if you recall, the pound took an awful hiding after the vote and continued to slide for quite some time. But that was on the view or the concern that Brexit was going to be highly disruptive and really damage the British economy. As often happens in these things, over a period of time, sanity is now starting to come back into the picture, starting to prevail once more. And as a consequence, you could expect that the pound will be stronger rather than weaker. And many foreign exchange traders who say the pound is the cheapest currency on earth. Not many foreign exchange traders who say the rand is the cheapest currency on earth. So you have your solution there. There it is. Just to show you the pound exchange rate. Did FirstRand buy in at the right time? I think that was really the subtext of the question that you asked. Here is a 10-year graph, and as you can see, we're back, as far as the rand is concerned, not much higher than where we were 4 years ago in 2014. So, and that gives you also a very good indication of what happened with post-Brexit, with that enormous decline in the value of the pound against the rand from over 22 back to just over 16. But the recent move in the pound has been in the direction that one would expect over the long term. And it's surely, if FirstRand were doing this deal at 25 to the pound, you would have to start scratching your heads. But it does look like the decision has been made at just about the right time possible. Moving on to the rest of the portfolio, or have we got more questions, Stu?
Like there's a question on Tesla, but I think we should move that to the global portfolio. But otherwise, it's all clear.
All right. Let's look at Discovery. There's one of our better performers outside of Naspers has been our other big winner. There hasn't been a whole lot of news flow on Discovery this month, in the past month, but the share price has been moving in the right direction, and I'm quite comfortable. Nearly 100 billion market cap, can you believe it, on this stock now? So we're very happy to be invested in Discovery. It's some of the smartest people in South Africa. What I like about this is that the investment that they've made in the UK has been in a sector, and that's through Vitality, in a sector where the competitors are not really that good. And that's because they have a public sector competitor. You don't really want to have health insurance or pay for health insurance if you're getting a good service from the government. But in Discovery's case, Vitality is offering health insurance, and the service from the National Health System in the UK, with a very overburdened exchequer, is that it's unlikely to get any better. So if you were to take a ground zero today, you would be saying you'll be investing against the NHS, against the National Health Service. That would be your bet. And that's exactly where Vitality is. The other story on Vitality is that it is doing extremely well in the life insurance area. You have a look at the recent results and you'll see how they're expanding there. So steady as she goes. Similar story here with Investec. Lovely picture there of Stephen Kossef getting his honorary doctorate from Wits, his old university. And again, nothing much happening at Investec in the past few months for the share price. It's been bumbling along, but I can tell you that within the organization, things are happening. You can see it. You can see the presence. You can see it from being a client of the companies. You can see it when you talk to the people at Investec. They are rejuvenating their private bank in the UK. It's really humming and expanding and starting to make some serious inroads. And you've got to remember this when you invest in a global market, and I've found this as well from our little Biznews perspective, you have to be educated first in humility. If you come into a foreign market and you think things work the way that they worked at home, or if you think that you can teach people in the new geography, and particularly an old society like the UK, how to do things, unless you're going into a very a sloppy area, and in my opinion, the big five banks could be, or it is one of those areas, and Vernon Hill's success has already shown us that with Metro Bank. But if you're going into an area where the competitors are good, and look at that in retailing, for instance, you cannot afford the luxury of arrogance. And that's the one thing that Investec have done very, very well. They're a humble bunch. They've come into the UK very carefully. They've been here for 20 years, I think it is now. And they are and they're moving in the right direction. So Investec is one of those sleepers. It's a fabulous business. They've got everything right. It's one that you can just put in your portfolio and not worry about it. Very happy to have it in the portfolio. Here's Mediclinic, and there's a story here, a big story. Mediclinic has been through quite a month. You can see the share price has fallen. The reason for that has been a dual thing. The chief executive, Donnie Manchis, has said that he will be leaving the company in June next year. That's never a good thing, particularly if your CEO is 61 years old and he's been around for a long time. But that's the way things work when you are 61, I guess, is that you're working for a corporate. He's been there, he's been steering the ship for a long time, done a lot of the credit for the internationalization is to his benefit, and he's decided to call it quits next year, which does give a new challenge, a succession challenge to the Mediclinic team. But Edwin Herzog, the chairman, has essentially founded the company, and he'll still be in the saddle. So I wouldn't worry too much about that. The one thing that you can worry a little bit about is the hostile takeover bid that has been launched for Spire. Spire is a British hospital services company, of which Mediclinic already owns 29.9%. No mystery in that. If they go to 30%, they have to make an offer. If they had gone to 30%, they have to make an offer to everybody, to all shareholders. So they stopped at 29.9, got to know more about the company. They're the biggest shareholders in Spire, and now they want to have 100% of Spire. So Spire, which is the listed company, came out with its results. They were awful. The share price plummeted. Apart from being poor results, they also had a huge exposure to one of their surgeons who appeared to have done some really crazy things. Can you imagine this? They put aside more than £25 million to meet liability claims, legal liability claims from one of their surgeons. Extraordinary. Anyway, as far as, so that's what's going on at Spire. The share price plummeted, and Mediclinic then launched a hostile takeover bid. First, well, it's become hostile because they made an offer to the directors of Spire. They felt, the directors did, that Spire was worth a lot more money than Mediclinic was offering it. And indeed, Mediclinic itself probably thinks so, because they're offering it under 300p pence per share, whereas they bought in initially for 350 pence a share, did Mediclinic. Mediclinic would probably argue that, well, the value of the company has dropped subsequent to its investment, so it isn't underpaying at all. But hostile takeover bids are never good things. They always shake up the staff, they hurt morale, and they're not always successful. So it'll be interesting to see how this whole thing pans out, but we've got to keep our eye on this space. From where I'm sitting, the takeover, were it to go through, would be a very good thing for Mediclinic. It would drop the South African exposure to below 20% of this company, making it a completely international business, or mostly an international business. And that means it's no longer subject to some of the vagaries of South African legislation in the healthcare space. Remember, Mediclinic's major investment is in Switzerland. About 50% of the business is in Switzerland now. About 25% of it is in the UAE. And a deal for Spire would turn that into even more of an international component. Is it a good business? You betcha. When South African doctors go around the world, they are admired, as are nurses, as are anybody really in the healthcare industry. It's one of those pockets of excellence in South Africa there, which has been exported very successfully. MTN, not a whole lot that we can talk about here. It's still going through its rebuilding phase under the new chief executive, Rob Shooter, and his team. In this case, I think quiet is good. They are being threatened with Turkcell with a long-standing court case. I'm not worrying too much about that because a judge has already looked at it, gone through it all, a UK judge, given his prognostication to say that MTN has no exposure. But the market is still a little nervous, so this is a time for a long-term investment that you should be looking at it. I love the new management team that's been put in place here. I love the chairman, Putuma Nhleko, one of the great entrepreneurs to come out of Africa. I love the fact that they're playing in a space and an area that they know, in the African continent and Iran. And I just believe that at some point in time, MTN is going to be too juicy an opportunity for a international player, for a Vodafone, well, not Vodafone because they already got Vodacom, but maybe one other international player. As things stabilize in Africa, and particularly in South Africa, you might see that happening. And even if that doesn't happen, MTN is a very, very good company with a huge base of customers who can be suggested to open their wallets a little more. So although the headwinds have come in from the old call, the money they would make from the call sector, that's being more than made up by what's going on in the data sectors that's expanding as we get into a networked world. So MTN is really a long-term bet on that and very good value. Steinhoff, wow, look at that share price. In the last month, it just dropped like a stone. What's going on with Steinhoff? I don't know. I hope we don't have another Brait on our hands here. Steinhoff, however, appears to have been hit by an allegation of a court action that's been going on in both Germany and the Netherlands. Steinhoff maintains that this is a court action that has been brought by a unhappy former joint venture partner who was trying to squeeze more money out of the company and threatened the company by going to the media. And as a consequence of that, those media attacks have come through, but somebody's taking a negative view of this, and I don't want to be too absolute. Do remember that Steinhoff has made some big investments. It's bought Mattress Firm in the United States for 55 billion rand. Now, what makes me feel a little more comfortable about Mattress Firm than you would be feeling about, say, a New Look, is that Mattress Firm is dealing in the bedding market. It's the biggest in the United States. It's not unheard of for South African companies to dominate whole sectors in the United States. You can think of Belron, which is the run by Gary Lavner, South Africa, the old from the old Lavner company, which is the biggest replacer of windscreens. So if you buy a windscreen in the United States, you're likely to buy it from one of the Belron subsidiaries. So it can be done. And Mattress Firm also has the huge advantage in that it is not exposed, well, not much anyway, to the Amazon effect. Amazon's wiping out industries now, but Amazon's strength is in being able to deliver small things to you quickly. Mattresses and cupboards, not that easy to deliver, and I've seen it from personal experience where I ordered 2 big cupboards, bookcases actually, and they have, I ordered them in August, they didn't arrive when they should have in September, then they still hadn't arrived when they should have in early November. I'm hoping they come next week. I might even be able to show you at the next webinar if they do come here, but it's not the area where Amazon's good. It's very good in small products, and Steinhoff is is in the discount market, where Amazon's also not very good, and in small products. So I don't know what's going on. I'll try and get hold of Marcus Jooste. If anything, it should be going the other way. After the listing of Star on the Johannesburg Stock Exchange, it was listed at 20 Rand 20 cents. It's gone to 23 Rand 90. So that's up, should be an uplift for the Steinhoff share price. Yet the shares are in under some pressure at the moment. Well, right now, I would be very comfortable giving this company the benefit of the doubt. And there's our portfolio overall. As you can see, we're 7% higher. We've now got 34% invested in Naspers and 18% in Discovery, 14% in Investec, 12% Mediclinic, and so on. And it's really a tale of two big winners, Naspers, Discovery. The third big winner we have sold out of, Glencore, for reasons that I've articulated earlier. One big loser, which was Brait, another one that's concerning Steinhoff, and then Mediclinic, which has got problems of its own makings at the moment. FirstRand just entered to the portfolio, and MTN, of course, is bumbling along. So as is Investec. So that's the story. I'm heavily invested in this portfolio, and I'm with you, and very comfortable that we are well structured. We have benefited to the tune of 7%. It's behind the JSE All Share Index, but these things tend to happen in that way sometimes, particularly as we were hugely underweight in Naspers, which has been the best performer of the JSE. If you took Naspers out of both this portfolio and the JSE, I think that you'd probably find that we were pretty level pegging at the moment. That's my story. Stu, if we've got anything more to add?
Alec, there's just a quick question on Tesla. Otherwise, there's nothing else. If you want to have a quick fire, it's from Paul Jeffries. He just wants to know what you're doing with the Tesla shares in the global share portfolio. I think he's just asking, following Felicity's newsletter, on the potential downgrade on the credit.
Yeah, Felicity and I have got opposing views on this. I'm a long-term holder. I'm a great believer that Elon Musk knows what he's doing, and I'm very happy to continue to hold the shares. I've been watching it. It dipped below $300 a share for a period, but it's one of those stocks that you have to know that in the short term it's probably overvalued, but in the long term it's probably horribly undervalued. And Elon Musk has he plays open cards. He puts his heart on the table. And that's always a good thing, that when you've got somebody who's prepared to share what's happening in the business with you. Also, he's a South African, and also it's not a huge investment we've got there. And we're making a massive profit. He's done us well. We bought around $200 a share, and it's sitting at $300 a share. 50% in a year. Please God, you could do that on every stock that you buy. So I'm quite happy to let the turbulence bump around now. We didn't buy Tesla to trade it. We bought Tesla as a bet on electric cars in the long-term future, and that's the reason why I certainly am not going to be panicked into selling the share in the same way as I haven't been panicked into selling Naspers. The decisions that we've made in this portfolio, and it's been interesting, in the global portfolio, which is now 3 years old, we made some significant changes over the period where we saw that things had changed, where we saw, for instance, that Novo Nordisk was not what it was made out to be. It was promoted as this wonderful Scandinavian business model to the rest of the world, and in fact, the CEO was even the Harvard Business Review #1 CEO in the world. But it didn't work out that way when the wheels started coming off there on the insulin maker. A similar thing with IBM. We bought the story of IBM until Warren Buffett decided not to buy the story anymore, and we followed him out of it. And there was there are going to be those kind of changes that you'll find. Same with Barclays. I didn't like Barclays because of the way that they treated the whistleblower. Not because of that instance in particular, but because of what it tells you about the culture of the business. We want to be in business with, and remember, when you invest in companies, you're a co-owner. We want to be in business with management teams who who share our values, and management teams that we can trust are doing the right thing and are sharing the information with us. That's really what, as a co-owner of a business, that's what you've got to be hoping for. The worst thing you can do as a co-owner of a business is to look at a management team or reassess your investment, not on the team that's running the business, but on the way that the voting machine, the share price, happens to be working at that point.
Excellent, thanks, Alec. I'm all clear this side.
Wonderful. Well, thank you for joining us today. It's been a pleasure. I do apologize for the technical errors to begin with, and these things happen from time to time, but I'm so glad that you were able to stay with us for the past hour, and look forward to being back in your company in a month's time. We will, now being November, we will be around about this time in December, before we go on holiday, or before South Africa goes on holiday. The rest of the world doesn't really do that. We will have another update. And don't forget that as a premium member, or member of Biznews Premium, you are welcome to send us emails. You are welcome to send us letters. We look after our premium subscribers, and we will respond to that in any way that we can. So please, you're a member of the club. We want to make you feel happy. We want to make you feel welcome, and we will do our utmost to ensure that that relationship gets expanded for years to come. Thanks for being with us, and look forward to catching up the next time. Cheerio.